Hello, Raul Lejeune here and Max Zanan with the Dental Protection Group. We're going to talk about some pain points that doctors face often when they first graduate from dental school, and then how to build their practice, and then how to leverage some tax beneficial and patient satisfaction beneficial warranties. But before we get into that, I just wanted to start with some of the big pain points of a dental student graduating from school. They've got some great clinical knowledge, of course, because they've graduated and they spent a lot of time learning how to prep crowns and take impressions for dentures, and maybe some are learning digital workflows in school. Most students, if not all students, they have a lot of debt. Max, you highlighted in your book here about $500,000 on average, plus or minus, depending on the school you went to. So they've got about $500,000 in debt. Now they have to operate a business, right? They need an LLC and a business and a lease, and they've got employees and they got customers, and they need to do marketing, and they got to manage a P&L, and right, there's a whole business that they need to run. And they've got customers, right? They're patients, of course, and they're providing patient care, but they are customers. They are humans who are making a buying decision, and they have to deal with customer satisfaction and reputation management. And so those three pain points are quite significant. And I would presume that a lot of young graduates really aren't prepared by their dental school in dealing with those. So let's start off there. Max, given the research you've done in the book you wrote, what are some insights there to those three pain points that a dental student faces when they graduate?
You know, the funny thing is that oftentimes they go to dental school because their parents are dentists. And there's nothing wrong with it. The only problem is that when their parents went to dental school, tuition was a fraction of what it is now.
What was it? Do you know what it was 20, 30 years ago?
I think it was no more than $15,000, $20,000 a year.
Wow.
So I don't think their parents realize how quickly tuition skyrocketed.
Yeah.
So now you're not only going to have the debt, right? Nobody thinks about the compound interest on the student loans, right? And yes, dentists are highly compensated, but you're not going to be able to pay off your student debt in a heartbeat. Normally, it will take you probably anywhere between 10 and 20 years.
Yeah.
And you know how mortgages are, right? By the time you pay off your house, that finance charge, the interest charge, is greater than the purchase price of the home.
Yeah.
It's the same math here.
Yeah, so working off your debt is stressful, going into business.
Don't forget there's another type of debt, right? Because yes, you have debt, you finished dental school, but you also have to live your life, right? Maybe you want to get married. Maybe you want to buy a car. Maybe you want to buy a house. So you take on more and more debt, and it's extremely stressful. When it comes to business, you know, it's really unfortunate that there is no business education in dental schools. Because, listen, you can be the best clinician out there, but if you do not know how to run a business, right? And I'll give you the best example. You know, let's say if you make an appointment at 1:00 to see Dr. Peterson, and his office is overbooked like an airline.
Yeah.
And they get to you at 3:30. I don't think
Not
you're
happy.
coming back.
Not happy. No.
Right. And maybe he is the best thing since sliced bread and canned beer when it comes to dentistry. But at that point, you don't care.
Yeah. Operational excellence and leadership and, you know, all the classic elements of a well-run small business need to be present, and including the clinical excellence. You know, assuming every dental graduate has a high degree of clinical excellence, what's going to separate them is really their ability to run a business, a profitable business, a reputable business that has repeat customers that come back and tell their friends, and, you know, and that's likely a result of the whole patient experience, right? And I think it's probably assumed by most patients that they're going to get good dental care. but the experience will largely be determined by everything else, right? How the staff treated them and all those things. And so let's talk about a dental graduate wanting to build their practice quickly. There's likely going to be an attraction to offering insurance or offering being an in-network provider for insurance companies. Talk about that and what kind of insights and data do you have on just kind of the history of insurance reimbursements and how that's going?
Right. So I don't think it's attraction. I think it's the only way to start, right?
Yeah.
Because nobody knows you from a hole in the wall, right? You're brand new. By definition, you don't have a following. You don't have previous customers.
Yeah.
Therefore, you don't have any referrals. So of course you're going to take insurance. And the problem with insurance is that your insurance reimbursement rates keep going down year after year. So I was told by a dentist that insurance reimbursement rates went down by 40% in the last 20 years.
Wow.
And that means that you have to work longer, see more patients. And this is where we get into the lack of operational excellence, right? So you have to overbook, you have to make people wait. And because there is so many patients that you have to see, you are not in a position to spend the necessary time to
Mm.
achieve that clinical excellence. You have to cut corners.
You have to go fast. Yeah. You gotta stack your calendar and make sure. I mean, the reasons airlines overbook is because there's data saying a certain number of people that don't show. And I'm sure dentists probably have some similar stats on, what percentage of their bookings don't show up. So there's probably a temptation to overbook or run a big schedule. Then if everybody shows up, now you're in trouble. Yeah.
Right, right. And at the end of the day, math is an exact science. So when you sit down, forget the business's P&L. When you sit down to do your family budget and you owe X amount of money in student loans, X amount of money for your mortgage, X amount of money for your car loan, you understand that you have to work longer. You have to take more patients. You have to accept more insurance plans. And at the end of the day, it's a rat race and you cannot get out unless you make a decision to get out. And that decision requires, I want to put it mildly, testicular fortitude,
Mm.
right? Because the fear is that where am I going to get patients? And what happens when I speak to dentists that left the in-network environment and became fee-for-service, yes, absolutely, they lost a lot of patients. But a lot of patients that were happy with their work stayed anyway and referred other people. And they are extremely happy making the switch.
Yep. Most doctors I talk to that have grown a fee-for-service practice, they do not regret it, right? They make more money, they have a better quality of life, and they have better patients. And building a practice solely on insurance is tough. It's really tough. You mentioned in your book, just the emotional stress of being a dentist and the unfortunate reality of, the suicide rate among dentists. Why don't you talk about that a little bit?
So compared to other professions, if I'm not mistaken, the depression and suicide rate are 4 or 5 times greater, right? And if you take everything that we've been talking about into consideration, um, you can understand why, right? But a lot of people underestimate the fact that it's an extremely unhealthy work environment, right? Where every single, customer or patient comes in and says the same thing. They say, listen, I hate dentists, right? So if you hear this day in and day out, right, and you're trying to do your best, provide the most amazing clinical care, and you still hear the same thing, I hate dentists, right? It's extremely disheartening and could be very depressing. And then you put the layers of debt, right? Because don't forget, besides the student debt, right, you take out a practice loan to open your own practice. And that could be anywhere from 500,000 to 1.5 million,
Mm.
right? And then because, we live in the age of technology and that technology evolves so quickly, you will have to purchase dental equipment on a regular basis, whether you like it or not, right? Just to stay competitive.
Mm.
And a simple X-ray machine could be $60,000.
Yeah.
So it's not a pretty situation, and I don't know if there is a study showing it, but I have a feeling that fee-for-service dentists are way less depressed.
Yeah. I can imagine that. And, fee for service dentists also get the opportunity to do a lot more of cosmetic and full mouth cases and things that are emotionally satisfying to the patient. And you know, I don't want to scare any, future dental students away from the profession because, rebuilding someone's smile, I would I would submit is probably one of the most rewarding things you could possibly do.
Yeah.
Right? When someone comes in and they can't get a job because their teeth are all crooked or they've got, severe periodontal disease or some other things, to rebuild someone's smile and to give them a new smile, I would suggest that's probably one of the most emotionally positive impacts you could have on another human being. And usually that, cosmetic type of smile makeover only comes through fee for service.
Yeah, it's very similar to plastic surgeons that actually, uh, let's say, I'll give you an example. You get into a car accident, right? Or you get shot in the face
Mm.
and they have to rebuild your face. That is extremely satisfying because they're giving you your life back. It's not an elective, implants type of a surgery. It's a
Right.
life-saving situation. And you're right, same applies to dentistry. At the same time, besides doing a more satisfying work, I don't think they got the fee-for-service dentist experience cash flow problems
Mm.
because you have to pay them as you go along. If you take dental insurance, you file a claim and that claim could be denied. And you could be chasing that money for 60, 90, 120 days and never get it. So when I look at a P&L of a dental practice, the first column is the production. And guess what the second column is? A write-off.
Mm.
And guess what the other column is? Adjustment,
Mm.
right?
Yeah.
So that production number becomes almost fictitious if you are in network.
Yeah. So, building an insurance-based practice to start is probably a smart thing to start doing, but then quickly trying to also add fee for service, procedures, more cosmetic procedures, implant procedures, veneers, things that are more elective. Also the positive emotional benefit you can make on people, I think, will impact the dentist's well-being and the staff well-being, right? When people are crying with their new smile, right? Because they know that they're going to be able to get a job or, they know that they're hot on the dating scene now, right? Because they've fixed some of their cosmetic flaws. So in growing a fee-for-service practice, there's another element of being also, quality and price competitive and having a high level of customer satisfaction, which is critically important. And we'll talk about, dental warranties in a little bit and how they can help. But I wanted to shift gears and talk about, insurance and how it's used as a vehicle for, like Coke and Microsoft and Google. In your book, you mentioned they use this vehicle. I forget what it's called, the 831B microcaptive, right? So explain what that is and explain why these big companies use it, like Coke and Microsoft and Google.
So The easiest way to describe it is that an 831B microcaptive is a gift from the IRS.
Okay. Well, the IRS doesn't really give out gifts, Max.
Right. So this is a gift from the IRS, and that gift is nothing new. It went into effect in 1986. So we're talking about almost 40 years ago.
Okay.
So 831B IRS code allows you to open a captive insurance company. All it means is that the owner of the dental practice will own an insurance company. So it's captive.
So okay, so if I'm Rob Leisure, I own Rob Leisure Family Dentistry LLC, and then I would also own Rob Leisure Insurance
Correct.
Corporation.
Two separate corporations,
Okay.
but you are the owner of both.
Okay.
And the reason IRS allows this is very simple. You can purchase insurance on the market from a regular insurance broker, right? Let's say you needed to buy cyber insurance for your business.
Sure. Yeah.
You can contact your local broker and purchase that insurance on the market. But then this was not designed for that type of insurance. It was designed for type of insurance that you cannot, in most cases, purchase on the market.
So it has to be for insurance that you can't find.
That would be the first reason to do that.
Okay.
The second reason to do that is maybe you can find that insurance, but maybe you can do this cheaper than getting it on the market. So these are the two main reasons to open a captive insurance company. So the key to understand here is that unlike your business or my business or a dental practice business, insurance companies are taxed completely differently. All of us, whether we're dentists, dental lab owners, or just small business owners, whether we like it or not, at some point during the fiscal year, we have to pay Uncle Sam.
Yes.
Unavoidable, doesn't matter what business you're in. Insurance companies, and I'll give you a longer version how it came about. Insurance companies have been lobbying Congress for preferential treatment of their income since 1913.
Okay.
The reason they've been doing it since 1913 is because up until 1913, there was no income tax in the United States. And income tax was instituted to help pay for the World War I effort. And it was supposed to be temporary.
Oh, man. Yeah.
So fast forward 111 years, not only that you still pay an income tax, it keeps going up. So once income tax went into effect, insurance companies started lobbying Congress to get preferential treatment on their income. And their income is called underwriting profit. And underwriting profit is very easy to understand. It's money left over after claims are paid. That's the profit that the insurance company earns. And again, this might sound unbelievable, but it's true. That profit is not subject to income tax.
So let me get this straight. So if I collect $1,000 in premiums and I pay out $200 in claims, that's $800 of underwriting profit. Is that what you called it?
That's exactly right.
And that $800 in value is not taxed.
Correct.
Even when if I take a distribution, or it's just not taxed at the corporate level?
It gets better, right? Because when you paid, let's say, that $1,000 in premium to your insurance company, you didn't put it in the safe, right? In the insurance company.
You're talking about the payer paying out the $1,000?
Yeah. So when you first paid for the premium, not for the claim, right?
Okay. Right.
So you paid a $1,000 premium for an insurance policy to your captive insurance company.
Okay.
When that insurance company receives that $1,000, they're not going to put it in the safe, right? They will do what other insurance companies do. They will immediately invest the money in the market.
Yeah. Go get a 8% rate of return or something.
Exactly.
Yeah.
Exactly. So not only that you get underwriting profit that's not subject to income tax, during that year, let's say if it was a year-long policy, you would earn investment income.
Okay.
That investment income is subject to tax, but it's only subject to long-term capital gains, which is significantly lower compared to ordinary income tax. And then, like any other insurance company, you have three options when it comes to dealing with that money. So first option, you can just leave it there, right? So it continues to compound. Second option, you can take a distribution and pay a long-term capital gains tax.
Got it. So when I take the distribution, there will be a capital gains tax, but the corporate entity won't pay taxes on
Exactly right.
the operating the profit that it's making in the
Exactly
delta
right.
between premiums and claims.
Exactly right. Or you can borrow from your insurance company.
Sure.
And if you borrow, as long as you pay yourself back with interest, then there is no taxable event whatsoever. So, for example, if a dentist accumulates X amount of millions of dollars in his captive insurance company and decides to acquire another practice, you can borrow from yourself, buy that practice, and have the new practice pay back the loan from the cash flow of the new business.
Right.
You don't have to go to, any of the standard banks and negotiate. You don't have to do anything. This is your money.
You're being your own bank at this point.
Correct. Correct.
So we just jumped right into the construct of this microcaptive, but let's approach the same discussion through a dentist with the dental practice with a patient in the chair. So let's assume I'm getting a dental crown and I'm the patient and you're the doctor, and I'm going to pay $1,000 for a crown. And if you're offering an insurance policy on this crown, walk me through how would you talk to me as a patient? What does it include? What's my protection coverage? And are there any if I walk out and I bite a bottle cap the next day and break my crown in half, am I covered? Or
Right.
just walk me through $1,000 crown. How does this look inside the practice?
So if we're talking about a fee-for-service practice, when we, sign that type of a practice up to offer dental warranties, the cost of the warranty is 15% of the cost of the procedure. So in a fee-for-service practice, it's not that hard to raise their prices by 15% and just include the warranty in the cost of the procedure.
So I'd have to raise my price to $1,150.
Correct. But a lot of marketing benefits come with that, right? Because if you decide to do that, the idea is not to keep it a secret, right? The idea is to shout from every rooftop, put it on your website, put it on your social media, include it in your text and email communications with patients and say, hey, our dental practice is different. We're not like our competitors. We stand behind our work. We guarantee everything for 5 years. So the patient is covered for 5 years for the dollar amount that they spent on the procedure. When it comes to negligence, of course, blatant negligence would be denied, and rightfully so, right? So the patient has to continue.
Well, let me ask Max, if I'm the doctor and I own my insurance company, can I still cover negligence if I want to for
Correct.
reputational management?
That's exactly right. So if it was not owned by you, right, and one of the exclusions on the contract was patient negligence, there is nothing you can do, right?
Correct.
That
If it's a
claim
third
would be
party.
exactly
Right.
that claim would be denied. But since you are the owner of that insurance company, you can override that decision and say, hey, for the sake of reputation management or for the sake of maintaining a healthy client relationship, I'm going to do it anyway.
Going to cover it. And so the dentist owning the insurance company has the final say in what claims they accept or
So
not.
the dentist actually becomes the ultimate judge and jury when it comes to
The CEO of the insurance company, right?
right. Right, because when they call us to file a claim, the only thing our people are trained to do is to process the payment. There
Okay.
is no adjudication process that's involved. We do not require any supporting documents such as images or x-rays, nothing.
So as long as the doctor says, this is a claim, I want it covered, let's cover it, it's done.
Correct.
Okay, walk me through though. Back up. We talked about fee for service, so we got our $1,000 crown. Now it's $1,150. Obviously, there'll be a discussion and a debate around, the ability to sell a crown at a 15% premium. You're gonna have to talk about the warranty and the coverage and all of that. But let's say a patient walks in and they've got insurance. How do I
Right.
how do I talk to them? Like,
But
are they
before
now
we get
excluded from my
right,
warranty?
right. But before we get there, let's talk about the actual concept of warranties, meaning that every patient is a consumer first. And
Okay.
every single consumer, including you and I, intuitively understand what a warranty is. So it's not like the dentist has to get into these complicated, convoluted conversations, right? We all know the meaning of a warranty, and in many instances, that warranty is the deciding factor when it comes to purchasing anything. And again, the best example I can give you is Kia and Hyundai, right? Don't believe anybody who tells you that they bought the car because it's good looking, right? They bought the car because it comes with a 10-year, 100,000-mile warranty. That's the only two brands in the United States that offer this type of warranty. If you buy a Honda, it comes with a 3-year, 36,000 miles. Same for Toyota,
Yeah.
right? So we know what a warranty is. So whether we're fee-for-service patients or in-network patients, we understand it. And in my mind, a fee-for-service patient can afford to not get the warranty, right? Because they can afford to pay for their dental care out of pocket if something goes wrong.
Yeah.
In-network insurance or dental insurance in general is completely different from medical insurance. And I will explain it to you the way a dentist explained it to me. So he says, Max, let's say you have medical insurance and you break your finger today. Your medical insurance will cover everything. And then you break the same finger next year and they will cover it again. And then you break it again next year and they will cover it again. Dental insurance does not work like that.
Yeah, you are correct. It does not.
Right. So I think not any, but I think every single dental insurance company allows you one crown every 5 years.
Right.
So you go in with your, let's say, I don't know, whatever insurance plan you have, and the doctor says, hey, your insurance will cover the crown, but if you want to get the warranty, it will be X amount of dollars out of pocket because your insurance company does not cover that. So to me, that makes perfect sense because if that crown fails in 3 or 4, 4.5 years, you will not be able to get it fixed and get your insurance company to pay for it. They will automatically deny the claim.
Right.
But
Because
if
there's a
you have
limit.
the warranty, you have nothing to worry about. You're actually shifting risk to a third party.
So if I do have insurance, I have dental insurance and I'm getting my crown and my insurance company is covering it, can I participate in this warranty at the dental practice? What does that
Yes.
look like?
So the way dentists do it, they create a separate billing code for the dental warranty, and they just don't submit that code for reimbursement.
So the
It is
patient has to pay.
right. It's the same way they treat a toothbrush or a bleaching kit because none of those items are covered by your dental insurance either.
Got it. So the patient on the $1,000 crown, so the patient would pay $150 elective coverage at that point. They could either accept the coverage or deny it. And
Correct.
if they deny it, then the dentist has their own goodwill warranty that they'll have to work out with the patient.
Exactly. But if properly presented, I think not that many people will deny it.
Yeah.
As long as they
What?
understand how different dental insurance is from medical insurance.
For sure. For sure. Okay, so let's talk through the nuts and bolts here. So if a doctor is interested in getting started, you had mentioned on a different call that it's 15% of every procedure. So like walk us through the list of procedures that are covered and then how that's paid for and just walk me through the mechanics of this.
So we cover every single procedure except for hygiene and extractions. So whether it's fillings, bondings, crowns, sleep apnea appliances, um, bone grafts, root canals, we cover it all. And we cover everything for 5 years for the entire dollar amount that the patient spent on the procedure. The benefits go both ways, right? Because the patient gets a peace of mind, like with any other type of warranty. But there are tremendous, like I mentioned, marketing benefits for the dental practice. So if you do shout from a rooftop, you will get a flow of new patients, right? Because I think I gave you an example on our previous call. In my zip code in New York City, there were 70 practices, and that's just one zip code.
Wow.
So
Yeah.
which one do you go to? Right? So if they turn this into a marketing tool, that's great. But then, besides acquiring new patients, the way the warranty contract is written, there is a retention element built in. So in order for the patient to keep the warranty active, they need to go back to the dentist for regular checkups.
And the doctor gets to determine that recall. It could be
Exactly.
6 months or 1 year recall or whatever.
Exactly. And think of it this way. When you buy your brand new Honda and it comes with a factory warranty, you still have to go back to change oil.
Yeah,
And if you don't, right, and the engine seizes, Honda will be very quick to deny the claim.
of course.
There'll be no goodwilling of anything.
And that's ultimately it's the goodwill of the doctor that backs most care today. If the patient paid for a warranty or it's baked into the treatment, right now the crown's $1,150 and the doctor sold me on my coverage. Then he has some outs, he has some abilities to hold, to underwrite the claim or not. But at the end of the day, he has the final say.
Mhm.
So if there's patient negligence or if the patient didn't come back for 2 years, he could still elect to cover it, correct?
Correct. Correct.
So now
Or not.
or not, right, or not. Just talk me through the mechanics now of, okay, so let's just stick with $1,000 crowns because the math is simple. So as I'm doing these cases, the average doctor does, about 1 crown a day. Let's call it 200 crowns a year. So what does the math look like that accumulates with this procedure, with this warranty program?
Well, I'm sure they do other things besides crowns.
Of course they do. Of course they do.
So the idea is to warranty everything you do, right? The same way it doesn't matter which model of Honda you are buying, right? Every model comes with the same warranty, no exceptions. So, so we talked about getting more patients. We talked about retaining more patients, but also it's very important that treatment plan acceptance rates go up because you stand behind your work,
Hmm.
right? So especially when it comes to really expensive procedures. So let's say if I need to spend $100,000 on full restoration, I'm definitely buying a warranty because goodwilling is very subjective, right?
Totally.
And I'll give you an example. I asked the dentist how does he goodwill his work, and he says, "I goodwill it if I like you." Okay, but what if you
Yeah.
don't like me?
Yeah. Yeah. No, exactly. No, I get it.
Y-
So
y-
so
You
let's
know,
say
so
that,
so
yeah,
that's what I'm saying. Like you will actually sell more treatment plans if you back them with a warranty. So overall, your revenue will go up as well, right? And
Yeah.
then you should not have really any negative reviews or peer review cases, because you can fix everything because everything is warranted. There are no co-pays, there is no deductible. You don't have to fight with anybody, right? Because a lot of dentists do the following. They say, Rob, I'm going to warranty this crown in-house for 5 years, but that warranty is going to be prorated. So if the crown fails during year 5, you would have to pay me 80% of the
Like a
cost.
stair step over the
Correct.
time. Yeah.
Correct. And I don't think you would want to hear that, because whether you pay an 80% or 100%, it's almost the same,
Yeah.
right? Whereas here, you are covered 100% as a patient. And
Yeah.
instead of goodwilling, the doctor will get reimbursed. So there's
Yeah.
nothing to write off.
So on a $1 million practice, if I'm doing $1 million a year in all my procedures, a smallish practice, then there would be 150,000 that would be going into my captive insurance company, and then that 150,000 is the pool of money that's used to reimburse the claims. Correct?
Correct. And every dentist needs to go through their internal records and really understand what their remake ratio is, right? And if they understand that their remake ratio is hovering around, 3, 4, 5%, then this is a no-brainer.
So, how does your company? What service does your company provide? How do you make money? Obviously, you're not a philanthropist. What's
No.
that cost to the dentist? And what's the partnership look like?
So we do all the heavy lifting, because we are not looking to make dentists into insurance executives, right? They really need to remain dentists and provide phenomenal clinical care, and now have an ability to monetize their good clinical work. So what we do is the following. We first open an insurance company that is going to be owned by the owner of the dental practice.
Okay.
So we do all of that. Once that insurance company is opened, and please understand, that insurance company exists on paper. There are no employees, there's nothing. It exists on paper for a sole purpose of being treated the same as any other insurance company when it comes to taxation. And this is the reason why you cannot keep these premium dollars inside the P&L of your practice, because your practice gets taxed like any other business.
Right.
So once we open an insurance company, the next step is we open a brokerage account, and we work with 2 investment banks. It's you can choose either Morgan Stanley or Raymond James. Again, both are super reputable household names.
Yep.
And so now there is a complete chain of custody, meaning that you own the dental practice, you also own a separate C Corp, which happens to be an insurance company, and that insurance company has a brokerage account with Morgan Stanley or Raymond James. So once the premium dollars go into the brokerage account, I don't make any investment decisions. I don't work for Morgan Stanley, right? So what happens first is that Morgan Stanley calls the doctor, and they interview them to find out what risk tolerance they have. And according to their risk tolerance, that's how money gets invested.
So I can be more risk averse. Maybe if I'm a little older in my career, or if I'm young and I want to take on a little more risk, I could, maybe go NASDAQ, S&P, or do some technology companies or whatever. So I can, you know, deploy my premium investment into any type of vehicle that I want.
That's exactly right. The only thing that we do, we provide investment guidelines.
Okay.
So, for example, when we do this in automotive, investment guidelines are much stricter, because I think everybody understands that no matter what car you have, if you drive it long enough, it's going to break down.
Sure.
So when car dealers set up these reinsurance companies, they know that there will be at least 50% claims ratio. So for every dollar in premium, 50 cents will come out to pay future claims. Therefore, we are not in a position to tell the car dealer or the boat dealer, go nuts, and go super aggressive with your investments and put everything on black in Las Vegas.
Of
So,
course.
so in car business, the most aggressive, believe it or not, is 80% 80% bonds, 20% stock. More conservative would be 90% bonds and 10% stocks. With dentistry, it's actually much, much better because dentists do a phenomenal job. And we have the data on the loss ratios. Dental procedures do fail, but they do not fail at the same rate as cars. Therefore, we let them go much more aggressive with their investments. So the
What?
most aggressive they can go is 50% stocks and 50% bonds.
Tell me, what's the data you see on failure rates of different types of procedures?
So fillings fail, right? They
For
do.
sure.
And that's good, right? And I'll tell you why it's good. And this is why we warranty every single procedure instead of cherry picking the ones that are going to last forever, right? Because if you do not have claims, you do not have proof of risk. And if you do not have proof of risk, why are you owning an insurance company?
So the claims legitimize your insurance company and protect you from being accused of
Tax
fraud,
evasion.
tax
Of tax evasion.
evasion.
Right, because it sounds counterintuitive, but claims are good. And nobody is perfect, right? It's not a reflection on your work. Things happen.
All right, so let's say I'm a doctor and I've been in business, 10 to 15 years, and I'm providing the, all on X procedures. And I start up with your company and I'm in month one. I do an all on X procedure. I charge $50,000 for a full upper and lower implant prosthetic procedure. Everything's great. Patient's fine. Patient loves it. 6 months in, the patient has a failure of one of the arches. So on a $50,000 procedure at 15%, what is that? I'm not
7,500.
7,500 goes in, but now I've got a $25,000 claim. What happens?
So
How do I manage that, and do I have to eat that now?
no. So if this was a case of self-insurance, then the answer is yes, you would have to eat it. Or you would have to say, okay, my self-insurance insurance company is out of business, right? Because there's not enough money to pay the claim.
Right.
We do not do self-insurance. We do reinsurance. So
Yeah.
reinsurance
What's
means
the
that,
difference?
so
What's
the
the
difference
difference?
is that self-insurance means that as long as there's money to pay claims, you are in business.
Okay.
But in the example you just gave, you're out of business.
Yeah, insurance company's bankrupt.
That's it.
Yeah.
That's it. So what we do is reinsurance, meaning that there are two types of insurance companies in the world. The number one type is the one that we know, all of us know what it is. For example, you see their commercials on TV, Geico, Allstate, Liberty Mutual. They sell insurance to people like you and I. Same goes for home insurance, car insurance, medical insurance. Uh, the other type of insurance companies is called reinsurance companies. And you never see their commercials on TV because they're not looking for you and I. We're not their clientele. They sell insurance to other insurance companies.
Oh, like an extra layer of protection, or be it like someone covering an insurance company for like a mudslide that took out 100 homes and they
That's
couldn't
exactly
cover
right.
it. Right.
That's exactly right. So what we do, and you asked how we make money, right? So we charge an administration fee on every warranty produced by the dental practice. But the bulk of that fee goes to purchase contractual liability insurance policy from a reinsurance company. So now let's go back to your example. You need $25,000 to redo the procedure, but there's only $7,500 in Morgan Stanley. No problem. At this point, this is defined as a catastrophic event, and a catastrophic event means that claims dollars exceed premium dollars.
Right.
So in this case, the first $7,500 will come out from Morgan Stanley or Raymond James, and the other $17,500 will be provided by the reinsurance company.
Okay.
So the patient and the doctor are always made whole. Because at the end of the day, when the doctor gives a copy of the warranty contract to the patient, right? That patient has no idea and doesn't care how you do it. They have a legal document.
Yeah, they
They're
just want
fine.
they want their coverage. They don't care
Right.
how it gets
They're
done.
not going to say, well, I understand, doctor, you ran out of money in your Raymond James account. You will never hear that.
Yeah. Yeah, for sure.
Right.
So what is the fee then on the $1,000 crown if I'm collecting 150 to
So
go
we
into
charge a
my
30% admin fee. So 30% of 150 is $45.
okay.
So bulk of that money goes to buy that insurance policy from a reinsurance company. And the remaining $105 will be going to your brokerage account. And then it just starts to get invested and compound.
But the reinsurance only comes into play if I go bankrupt in my insurance company. So let's say I'm in year 2
Mm-hmm.
and I have $150,000 in my Raymond James account, and I have a claim, a big claim, a $25,000 claim. I then, as the CEO of my insurance company, have to pay for all 25. I would only tap into the reinsurance after the Raymond James account goes to zero.
Correct.
Okay. So the 30% covers the reinsurance, which is understandable. But when I'm in year 3, I likely have enough capital to cover my costs. What continued value are you guys providing in year 3?
So remember, I think in our previous conversation, I mentioned that when you open your insurance company, it has to look and smell and walk like an insurance company.
Sure, it's got to be legitimate.
It's got to be legitimate. So you have to, renew the licensing every year. You have to make certain filings with the IRS. You have to provide tax returns for your insurance company on an annual basis, like you do for any other business. And we take care all of that. So for the dental practice, it's completely hands off. So we set up the insurance company, we open the brokerage account, we provide monthly statements, we file annual tax returns, we provide an online portal to enter the contract, we answer the phone to adjudicate the claim, we process payments. So we make this completely legitimate. Because let's say if we are out of the picture, all of the things that I just mentioned, that dental practice would have to hire somebody to do all of that.
So you mitigate the risk of any tax evasion, or you're going to make sure, because you're on the hook as well, make sure that the doctor is
Right. Don't forget,
operating properly.
we are signing, right, these tax returns. So if there'll be an audit, whether we like it or not, we have to be a part of it.
Got it. Okay.
And the problem is that in the beginning I said it's a gift from IRS, right? And the gift in 1986 was $1 million, meaning that you could put away $1 million in premium dollars per calendar year. Since then, every year Congress reauthorized a higher amount. So in 2024, the amount is 2.85 million.
Per year.
Correct. That's a tremendous gift from the IRS.
So that means if a doctor has a multi-site practice under one umbrella, he could put up to 2.8 million a year in premiums tax-free.
Yes.
And then he only pays taxes if he takes a distribution, or does he also pay taxes on the growth, right? The economic growth of that portfolio.
Well, the investment income portion of it is subject to long-term capital gains. So because this is such a tremendous gift, people are greedy, and there has been plenty of cases where this 831B microcaptive insurance structure gets abused. And if you do abuse it, you will get caught by the IRS, and rightfully so, right? Because I'll give you a famous example where a jeweler in Arizona uh, set up an 831B microcaptive insurance company and paid $600,000 for 1 year kidnap and ransom insurance policy to that microcaptive. And when the year was over, and there were no claims, that $600,000 becomes underwriting profit and not subject to income tax. So IRS said this is unacceptable because when was the last time somebody was kidnapped and ransomed out of a jewelry store? Right?
Oh my
And
gosh,
why are
yeah.
you paying $600,000 for the policy when you can get it on the open market for a couple of $1,000s a year? So
Yeah.
that's
Because the
blatant,
risk is super low. Yeah.
right? It's blatant abuse.
Yeah.
So, so our job is to make sure that we do everything by the book and don't abuse the system. Because I'll give you an example how to abuse it. Right? You would say instead of 15%. I would like to charge 50% for my warranties. But that would be absolutely ridiculous, and it will never fly.
So it's almost like the ratios of how much money you put in and the claims you take out have to be within like a range of
Correct.
acceptability.
Exactly. So all of a sudden you say, "Hey, Max, I want to do 50%. Here's, $2.8 million. Best of luck." Uh, Believe me, this is not going to work. We would never agree to it because our reputation is on the line also.
Max, this has been a fun discussion. Any points you want to wrap up with as we wind this down?
So, so this is a standard operating procedure in so many industries. It's unbelievable. It's not just car dealers that do it. I'll give you another example. Enterprise Rent-A-Car. Why would they buy car insurance from Geico or Allstate when they can buy it from themselves, right?
Absolutely. Makes perfect
Right.
sense.
This has nothing to do with tax evasion. It's just smart money management. And for some unexplainable reason to me, and again, we're talking about something that's in existence since 1986. Nobody is doing this in dental. Nobody.
Huh.
Nobody has ever heard of this. This is mind blowing. The amount of money that dental practices have been leaving on the table the last, 38 years is just unbelievable.
That's really cool. Well, great
Yep.
opportunity, Max, for sure.
Yep.
Dentistry in many ways is behind the times in some of the business aspects, but we're catching up, and a lot of technology innovation. Rebel 3D, we care a lot about technology and solving doctors' technology problems. But I wanted to have this conversation with you because I thought it interesting what you're offering and what you cover. And I'd like to close with just saying that, I'm thankful for dentists and dentistry and restoring smiles and enduring that stress. And I can see that having this dental warranty would actually be a great thing for a dentist's mental health and how they manage
Yep.
patient satisfaction and reputation management and making sure their Google reviews are 4.5 stars or better, right? Because their patients are covered and they're not denying those goodwill warranties that they feel are unfair, and maybe they are unfair, right? Patient has an unrealistic expectation, but if the doctor's covered, then they can still cover that unrealistic expectation without the financial burden.
Yeah, absolutely. And also, I think if you happen to be a dentist who is in network and you are ready to start transitioning to fee for service, offering a dental warranty on all of your procedures will create a following. Don't worry. People will come to you because of that.
Yeah, for sure. Yeah, I think offering really good coverage is very compelling, right? And could make a difference. So Max, thank you. Thank you for your time. And I'll put your email address and your company name in the YouTube description so people can click and find out more about you.
All right. Amazing. Thank you so much, Rob.
Thank you.